everyone, Andrew here, and welcome to another Wisdom Update. Look, it's been a little while since I've done one of these, and I did think that it was really timely with a lot of stuff going on in the economy that we did another update and told you about all the things that are going on. I also really wanted to share with you today a few of the different resources that I personally look at and I read to get a good objective view of what I see going on in the economy. You know, we all know that mainstream media, they really just want to sell papers. They want sensational headlines to be able to, attract your eyes and keep you reading, all of their various clickbait. And look, I like to look behind all of that, look at the objective data and the various sources that you can get that objective data, and then form your own view about what's going on and, what's important to you with regard to the economy. So let me share my screen. I'll show you these resources, show you what I'm talking about, and give you a bit of an update in what I'm seeing and the view that I have across the economy right now. Okay, so where I wanted to start was really with the monthly CPI. So very recently, only this week, in fact, we saw a new monthly CPI, Consumer Price Index, data come out, and it was really, really good news in Australia's fight against inflation. We saw the headline rate for the 12 months to August drop into the target range of the Reserve Bank, which is essentially the inflation target range is 2 to 3%. That's what the Reserve Bank says that they want inflation to be. We've seen that drop into the range for the very first time in now quite a long time. So the headline rate was 2.7, but one thing to take from this is that the 2.7, unfortunately, has been quite heavily impacted by the electricity subsidies that have been going on right across Australia. So the reality is that the headline rate of being 2.7 doesn't really tell the whole story. However, it does certainly continue to tell the story of that inflation is dropping overall. And of course, inflation dropping is good news for the economy. Not necessarily good news for employment and other things and investment, but it's certainly good news with regard to interest rates. Now, you can see that where we're looking at this data is actually on the Australian Bureau of Statistics, their website. So their website, anytime that they do a release, anytime that you see CPI quoted, 9 times out of 10, it will either be a private organisation that are doing their own view of it, but the official one is always the Australian Bureau of Statistics, who release this data essentially every month. Now, what does this mean for the Reserve Bank? Does it pave the way, as a lot of people are saying, for interest rates reductions? Not in my opinion, not yet. We will talk a little bit further about that, and I'll show you as to why I have that view. But I've held the view for a very long time that we won't see any rate reductions until that first quarter of 2025. So I'm expecting that because it's a February meeting now, because the Reserve Bank meets less often, now they only meet 8 times a year rather than the 12 they used to. So the first meeting next year will be in February. I'm really not anticipating that we will see any rate reductions before February next year. However, this is good news because it obviously makes a stronger and stronger case for why interest rates don't need to remain at the elevated level that they currently are. If we cut across now onto the Reserve Bank of Australia's website, under their publications, you can actually go to their statements that they release on monetary policy. So every time they do a meeting, and they obviously look at the economy, they make decisions around the cash rate, and anything else that it is that they're looking at, they obviously release quite an in-depth statement. And you can download that monetary policy statement here. And, that goes into, again, great detail with regard to all the bits and pieces that are going on, not just in Australia's economy, but in the world economies as well. And yeah, if you don't have a life, like I don't have a life, and you'd like to read this stuff and get into the detail of all of that, there's certainly plenty to keep you happy. But what I did want to really call out was on page 12 is around the interest rate expectations. So I obviously said that I am not personally expecting that we will see any reduction until the first quarter of next year. And largely the market sees the view the same as I do, in that there is a lot of talk, and I know the media, every time there is information coming out, like the CPI data, being within range and within expectations, they instantly go, okay, we're going to see a rate reduction tomorrow. I don't think that's the case. The Reserve Bank are hyper cautious of spiking inflation back up by reducing the interest rates too soon. They don't want to see that happen. And as a result of that, I think they're going to absolutely take, the cautious approach, the conservative approach, which means they reduce rates slower. And they also sort of delay rate reduction until they're absolutely sure that that's necessary. Now, history shows us that is normally too late. right? So normally the horse is bolted and you know the economy is already being, you know, overly heavily impacted by it, and then they reduce rates too late in the process. I actually, look, whilst I don't agree with that, I expect that behavior isn't going to change, right? So they've always done it too late in the past. The likelihood is that they will do that too late in the future as well. I also expect, and again, so that really the graph that I wanted to point out here is this one down the bottom. So I'll just, now, what's really interesting about this as well is that what the blue line here is this was the future expected rates as at the May meeting. So that's what they saw the market, or the market expected to happen with interest rates in the future. This is the cash rate, which obviously impacts all of the underlying interest rates that we pay on all of our home loans. As at May, they actually expected that was going to increase a little bit. And then, of course, we get into, this is the March quarter of 2025. And, you know, before we start seeing rate reductions. So that was when inflation was still sticky. If we think back then, and again, that wasn't that long ago, we're only talking about sort of 4 and 5 months ago, inflation was being really sticky. It wasn't being impacted heavily enough. We even saw a spike up there for a little bit in the overall inflation rate. And so the market did expect that potentially there were more rate increases coming before we saw reductions. Now, fast forward, you know, back now to, this was the 1st of August. So again, this is a little bit dated and more data's come out since then. But of course, you can see that this red line, the expected cash rate, is going to stay what it currently is. There's no further increases. And then this is the market pricing in the potential of, at the end of the September quarter, you know, the start of the December quarter, maybe there'll be a slight dip in that. I don't agree with that. I think at this point in time, there's less than a 25% chance that we see any rate reduction before the end of this calendar year. And only then it would be because, you know, GDP or one of the other measures, serious measures of the economy, unemployment rate, only if they spiked very significantly and unexpected would I think that we would see that. But of course, then we can see in this, you know, in this December quarter, which includes the start of next year, we can see that we're then expecting rate reductions, you know, to occur thereafter. Now, again, what's really interesting is if we look at the December quarter to the December quarter, you know, there is quite a significant overall reduction expected in the total interest rate. So right now, I would say that sort of looks like 1% all the way out to 1.5%. Me personally, I would suggest that we probably won't see more than 1% of total reductions across the calendar year 2025, maybe 1.25%, but I think it's still going to be very, very steady as she goes, you know, just chipping away at that overall interest rate rather than, you know, big rate reductions like 0.5%, and doing that overly quickly. I would expect we were just going to see really a very test and measured approach taken by the Reserve Bank when it comes to reducing interest rates over the course of the next year. So overall, as I say, you know, looking at the independent data, and again, you can read all of this detail. It's a 64-page report. You can look at all of this, but, you know, it's really looking at this objective data that I look at myself and go, okay, well, you know, from my view, I think we're going to see the first reductions occur in probably February, the February meeting of the Reserve Bank in 2025, and then we'll see 1 to 1.25% of reductions throughout the remainder of that year. At the end of the day, it's great news for us, all of us that are, you know, paying mortgages. It's certainly great news for us. And of course, I do expect that rate reductions are going to continue and support property value growth over the course of 2025 as well. So look, talking about, you know, the property market in general and what are we seeing and what's going on there, there was really, there's another source of data that I really wanted to show you guys as well with regard to, I just think this is a really nice, concise view of the property market. So of course we see CoreLogic, which are the people behind RP data. And, you know, a lot of information come out from that with regard to values in properties. And they obviously collaborate with realestate.com and the REA group and other sources of information with regard to, you know, what we're seeing with prices and prices generally. But Hare and Todd White actually do a really interesting, I think, a monthly report, which makes for really quite good reading, particularly in conjunction with all of those other sources of data that we have available. So this is free, and you can subscribe to this monthly newsletter that they send out, or monthly report they send out. It's free. It's on the Hare and Todd White website, and you can just go to this particular page, and it will give you obviously a downloadable version of the report. And also, if you sign up to their email, they will certainly email you that. I get an email every month to say that this report's available. And what I like about it is really, it's just, again, it's quite a detailed report if you want to get into all of the detail. But pulling out some of the more interesting bits and pieces, I really like that they do a property clock. So I've just got to get through all of the commercial. So this first section is all about commercial property. So again, if you're investing in commercial property, or if you have commercial property or that interests you, it gives you a good overview as to what's going on in the commercial property space across all of the different states and even areas within those states. And then if we get down to the residential report here, this is the one, graphic that they do that I really, really like. So essentially, we all know what the property clock looks like in the sense of it's the peak of market. Down here, we've got declining bottom and then rising market. And essentially what they do is all of the different areas, the major capital cities, and of course, those larger regional locations as well, or those larger regional areas, they essentially put each of those areas at where their view is, where that particular area sits on the property clock. And so I think this is really, really interesting because for me, it does really wrap up a very high level or a hell of a lot of data that's available out there on the property market. And it does actually wrap that up really cleanly and neatly with regard to, okay, if I happen to be living, I live in Adelaide, and if I want to be investing in Adelaide, I can look very quickly and go, okay, well, where is this sitting on the property clock? And at this point in time, it's a rising market. That suggests that all of my manufactured growth strategies or anything that I'm doing to add value to the properties that I own is probably going to go pretty well, and the market's going to continue to perform pretty well. But naturally, if it happens that, I'm across in Port Macquarie, at this point in time, they feel that Port Macquarie is actually a declining market. They're seeing values go backwards. They're seeing the immediate future of that market, that it probably continues, unfortunately, to get less valuable. And as a result of that, would we choose to invest in that right now on the likes of a manufactured growth strategy? Well, maybe not. Maybe we need to go to a different space or another location and pick up, a bit more of a market advantage. Now, do we invest just for capital growth? No, of course not. We've always got great underlying strategies to add value. And this doesn't take away from that. But at the end of the day, if the market's looking after you, plus your manufactured growth strategy is looking after you as well, of course, that drives overall better outcomes. So again, I just think that this is a really interesting resource with regard to, where the various markets are at any point in time. And of course, there's a lot more information. This is all of the units, where they start to break down each of those individual areas within those states. So right down the bottom here, we can get to the detailed data on essentially, why they rate each of those areas the way that they do and how that results in their overall position on the property clock as well. Now, there's good detail in there about value increases and other things as well, which you can dig into. But I just think this is a really, really interesting resource with regard to, getting a good idea of where an area that you're interested in investing in, where that sits at this point in time with regard to the property clock. And again, it's free, it's available to you, and I think it makes for really interesting reading. So hopefully you found that really informative and maybe a little bit helpful, and maybe some of those resources will be valuable to you as well. As always, until next time, happy investing and bye.